Okay. So I was answering quite a few questions. So starting with the forex trading, yes. See, forex trading, I will explain when I will start telling you guys about the derivative market. Then I will explain you about forex trading also, because I have segmented to explain you guys technical analysis followed by derivative analysis. So this will be giving you immense data, immense information to understand that how derivative market works. And even this is a subject from the security analysis paper. So that will also be very much helpful for you guys to understand that how derivative market is going to directly relate or directly going to impact you on your trading and investment perspective, and how you can hedge your equity portfolios when the market is really very volatile. Next question which I have received, that sir, what's your view on the share of Tata Motors? They are producing electric and eco-friendly vehicles, and there are the next generation vehicles, right? I hoping that it will reflect the stock market. See, looking at the overall perspective of Tata Motors, Tata being a very strong company, because that's not only the business purpose, but from the industrialist purpose, Tata has always been one of the top growing companies in equity market also. So yes, no doubt Tata Motors is also expecting a very strong movement from here onwards. But looking at the overall scenario of the overall automotive companies like Eicher Motor, Escorts, Ashok Leyland, because into trucks, heavy utility vehicles also, and small utility vehicles also. But the market share has been always been capitalized by Maruti, because if you will see the monthly sales data of Maruti, then it is one of the top leading companies in Indian stock market and in Indian market overall. So Maruti is being one of the most preferred companies for investment, and Tata Motor will be having a substantial move that we can expect, because the number of shares, the number of capital market or capital share that we can expect from the Tata Motors is slightly less as compared to Maruti. Coming to the point of EV, yes, no doubt EVs are being one of the major catch holders for Tata Motors as of now, but EVs are still out of the pocket for major of the middle class segment, because middle class segment still prefer Alto, Celerio, Swift, these kind of cars. So that, because that will be even pocket friendly and even ready to be used for even long and short trips both. But for EVs, the infrastructure is still in the developing phase. So if we will see the overall longer period for Tata Motors and EVs, no doubt Tata Motor is going to get a very strong move from here onwards. Currently, it is on stock prices, it is trading at 400 levels, and we are expecting that that has been taken care by the fundamental team. So they have been expecting that it is on the verge of moving towards 600 levels, 580 to 600 in a long-term duration. And long-term duration in equity market comprises of 9 months to 12 months. That means in 1 year of time frame, we are expecting 585 600 levels for Tata Motors, which is approximately 50% of return that we can expect. But at the same time, what we have seen that Tata Motors, because this has been on a very the EVs have been introduced way back, I guess 2-3 months back, people have invested in the EVs, and as of now, many of the many of the cars are coming from the EV backed up. So that has already given a strong rally, because from 300 280 zone to 470 80 it went on the higher end, and again it has came down towards, I guess, 400 410 odd levels. So from here onwards we are expecting the bullish momentum to continue. But if I will see the peer comparison, then Maruti is still the market leader, and it is outperforming in the automobile sector, followed by Tata Motors, even Ashok Leyland, Eicher Motor. These are also very good companies from the two-wheelers background. TVS and Hero Motor, both are performing really very well. So you always have to keep analyzing these factors. The questions which you have asked is very, very strong question, because this is something that means you are having a very strong connect to the market, connect to the economy of the country. And once you have the connect with the economy, then you can be a very strong investor also, because the time you can see that this is the next generation, next future need, then that is the time where you should also invest your money, because over a period of time you can see your money to get multiplied. Because even I'm saying from 400 to 580 is near about 48, 45, 50% of return. So that's also a very positive thing, because in a year or maybe 15, 18 months also, if you are getting this much of return, then it is outperforming every other asset investment class also. So that's a very positive question also, with a very strong fundamental backed company. So you can always prefer looking for Tata Motors for investment perspective.
Okay, sir. Thank you, sir.
Okay. The next question is, which is the best intraday or long-term trading? Which is the best intraday? See, intraday is basically for people like us who are into market every time. If you will ask me what is the price of Nifty, I'm having that much of numbers inbuilt in me that I can tell you that this is the support zone, this is the resistance, here you should buy, here you should exit. So it is for those people who are into the market. But if you are not into the market, then obviously long-term trading is very much important, and it will outpower even the traders, because traders one day they can make 1 lakh worth of profit, other day they can even erode 2 lakh rupee of profits also, or losses into loss. So that is something that is totally related in a trading market, because once my view gets wrong, I get either a stop loss, because we people as a technical research analyst, we people maintain strict stop loss, that if my view gets wrong, then I should not stay invested, and I should not stuck my capital at the same stock or at the same levels. I should exit, implying that I am committing a wrong analysis. I will exit from the trade and I will re-enter the same capital into another trade. So one should always keep a stop loss if you are a trader, if you are doing an intraday trading. But for long-term investment, obviously you can see outperformance in the market, because managing money every day will be a difficult job for each one of us. But managing money over a period of time, let's say from 6 months to 1 year, if I have to say, then I will be very much bullish in the market. But if you will ask me that whether I am bullish for Monday, I will be still tentative that whether on Monday market will move up or not. I have to see how the US market has performed. I have to see what are the economical data that has been linked, how the GDP has been decreased by the World Bank. It has been depreciated from 7.2 to 6.5. So it will be having a negative impact on the market. So n number of factors will come into picture if I will be doing a trading job. But if I am a long-term investor, for example, Tata Motor, I know Tata Motor is going to perform very well. So I won't be worried about my investment. I know that over a period of, let's say, 1.5 years, I will be getting a decent return of 40-50%, which is a very strong returns in any of the market. So if you are getting 20+% of return in equity market, that is considerable to be very good trade. If I wanted to invest in commodities, shall I prefer gold or sovereign gold bonds? See, I assume that gold here you are implying for physical gold, correct? So sovereign gold bonds give you an interest rate which is quite higher in terms of liquidity. Also, you can very easily liquidate it. Physical gold requires a lot of cut prices whenever you are going to sell it off. So if you are buying it from the perspective of that, I'll be trading on it, I will be buying now, I will be selling tomorrow, or maybe after 1 year, 2 year. So then you can go for ETF gold bonds. If you have the intention that I will buy it and I will see for my future generation, so that is something where you should buy physical gold, because physical gold will be having some kind of cut off while you will be selling it, because there will be making charges and a number of things will get cut off. So that will be something, your profit will get eroded with that much of amount that has been corrected. So better to have an ETF if you are investing in gold for trading for buying and selling perspective, not trading perspective. And if you are having a perspective of investment and let it be for a number of time, so then you should buy physical gold. Is there any possibility to exchange over shares for one broker to another broker? For example, if I had one trading account in Upstock and another one account in Grow, then who can exchange over shares from Upstocks to Grow? Acha, okay. Matlab, what I assume from this question that you are having one account in Upstocks, one in Grow, and you are trying to sell from here and buy from here, or transfer your shares from here to Grow to, let's say, Upstocks. So if this is the question, yes, that can happen. But again, that will happen on the market price. So you have to do a, I guess, DIS slip will be required. I'm not very much familiar with it, but this has happened because there will be a term called, some slip is there. I am not having the correct word for it, but there is some customer copy slip or something like that. But that you can showcase from Upstocks to your next Grow, and they will transfer your shares from one account to another account without any charges, no broking charges, nothing will be applied. What strategies do you use to evaluate risk? I will explain these things. Strategy, I have made a PPT also. I will explain everything in detail. What are the roles played by consultant in capital market? See, consultant are some person, for example, let's see me being the consultant over here. So I will give you a recommendation or a suggestion that if you are making this, if you invest this much of amount in these many financial instruments, you will be getting approximately 15 to 18% of returns. Over and above will be my uh, charges. So that could be seen as the consultancy that people provide. Not only people, we as an I am from the depository participant. So we people do not provide any kind of consultancy, but there are freelancers who provide such kind of consultancy, which will be, I will be providing you recommendations. I will be providing you where to invest, how much weightage should be given, and even in debt market, equity market, BFSI, everything will be taken care of. And over and above, let's say if we have negotiated over 12 to 15% of return for you, 15% of return, let's assume that is that will suffice your need. Then from 15% and higher levels, whatever will be the uh, returns, that will be taken care by me. Or there will be a initial charges, like say for 10 lakh worth of rupee, if you want to invest, then I will be charging near about 0.5% or 1% of on a 10 lakh rupee. And again, I will be recommending that whatever happens, even if your portfolios goes in loss also or in profit also, I will be having my 1% share. And I can suggest you some of the instruments where you can invest for your future requirement. You might have seen that one of the last Monday, the market was really down and bearish. So what do you think on or analyze behind this fall? I guess you are saying it for this Monday, correct? This week. So Monday, yes, we have seen a kind of a correction because of the global markets were not performing really very well. But if you will see the Friday closing of previous week, Friday, that has made a bullish engulfing pattern. I will show you the screen once. Just do let me know if you are able to see it. 1 second. Are you guys able to see the screen now?
Yes, sir.
Yes, sir.
Okay. So see, this is the question, I guess. This was the Monday candle, which has seen some kind of negative move. But again, from here onwards, we have seen a strong move from Tuesday, Thursday, and Friday. So what we have seen from onwards 18,000, from these levels, the market has been on the declining phase. These have corrected from 18,100 levels till 16,750. So see why technical analysis is very much important in identifying correct entry and correct exit is because if we will see from here onwards, there is a gap, correct? You can see from these two candles, there has been a gap. So from here onwards, the market have reversed. And the blue line that you are seeing is 200-day exponential moving average. So 200-day exponential moving average has a very strong significance on long-term structure of any of the companies, any of the stocks. So this was one of the support around 16,900. And secondly, these gap were one of the strong support that we were expecting, that if this would have been broken, then we were expecting that market would test 16,000 to 15,800 once again. But once the 200 exponential moving average along with the gap. From here onwards, what we have observed on Friday, that the green candle, this big candle, is a bullish engulfing pattern. What is bullish engulfing pattern? That the previous candle is a red short candle, and this candle is a very big, it has engulfed the whole body of the previous candle to itself. So from here onwards, this could be seen as a very strong reversal that can be seen, and this was because of the RBI monetary policy was on Friday. So on that basis, because we were expecting a rate hike of 50 basis point, and that is what has happened. So market has already factored in 50 basis point. If it has been 75 basis point, then we would have seen again a structure of sell off. But as it was as per the market expectation, then from here onwards we have seen a strong upside move. But from here also, if we will see the upside move, the immediate gap of this candle, because on 23rd September and 26th September, market has witnessed a gap down. So this gap is also very strong resistance, what we say in a technical language, where we can see strong supply zone, that one where whenever the prices reaches these levels, then we can see some kind of sell off. So on Monday, the global markets were not very bullish on Monday. So that's why even we opened on the higher scale, but again went down to retest the 200-day exponential moving average, the blue line. But from here onwards, next day, there has been some relief on the US market. US market has gained approximately, I guess, 400 points from on Monday night, or Indian Monday night. So next day, we have seen a strong move from here. Then again, this gap, the gap is still unfilled. So we were not very much optimistic that whether this will continue or not, but only because the global markets were having a relief rally from the kind of sell-off that we have seen. So again, we have witnessed after a midday gap was there. I guess Wednesday was a holiday. So after the gap, again, we have seen a strong move on the higher end, but the market have seen tentativeness around 17,500. I will explain you why 17,500, because that is something where a lot of open interest put writers have taken positions on the, call writers have taken a lot of positions on the 17,500. So 17,500 being the very strong resistance zone for Nifty. Then again, we have seen some kind of closer on a mere loss of 0.1% on Friday. So that could be seen as a okay, that's not a very ignorable or very significant move also. So this move is also indicating that the market is around those levels and expecting that from here onwards we can see a kind of rally, but 17,500 is the very strong hurdle also. So from now onwards, the 200 exponential moving average presented at 16,900 is supposed to act as a demand zone, and 17,500 is the supply zone. So in this broad range, we can expect the market to trade in coming future. So whenever these two levels are breached, either on the higher end or on the lower end, from there onwards, we can see either the 17,500. Once it breaches above that level, then we can see the rally to continue. If it goes below 16,900, then we might see the correction to even further aggravate. So these are the things that we people have to see on day-to-day basis, on technical basis, so that we people can find the best, try to find the best entry and try to find the best exit. But once it breaches, because as I mentioned that 17,500 is resistance, so I will start selling the calls, or I will start buying the put whenever the prices will come to 17,500. So that means once the market breaches above that level, that means once I have to get my analysis wrong just to see that whether it will cross 17,500 or not. Once it crosses 17,500, then again I will turn towards the buying side of the market. So these things you have to do. That's why there is no 100% of success ratio in market. None of the analysts can give you 100% success ratio, because we people have to analyze if this level does not crosses, then we will be buying here. If this level does not cross on the higher level, then we will be selling here. So if I sell at 17,500 and market crosses above 17,500, so that means first thing that my view will get wrong. But from there onwards, we can see that the rally will continue. So these are the few important things that we people analyze on day-to-day market. Even there will be various n number of indicators also that we people can see that why we should buy at these levels, why we should not buy at these levels. Even there will be options data that will be available, that what kind of put strikes you should buy at what levels. And 17,000, if I will say about uh, call option, then I will show you on NSE website, so that will be much clearer to you, because from here onwards you can see 17,000. If we will see 17,000 put open interest price, then it is around 62,000. So there will be a lot of sense that you can see from the derivative market also, that at what positions put writers have taken their position and at what levels call writers have taken their levels. So there will be a number of things that we people have to keep tracking every day. So there will be n number of tools also that will simplify your view, so that you can have a better understanding about market, that when one should invest, when one should exit. So these are some of the things that you people will get to know once you are into the equity market. As of now, I'm not even expecting that you should know everything about this, but for making money, for understanding market, for understanding how to invest, where to invest, these things are something which is very much important. How many sectors are there to invest in the stock market? Yes, very nice question. And for that, I have a website called NSE. NSE will give you how many sectors are there. I will showcase you once. Is the screen is visible?
Yes, sir.
Okay.
Sir.
So see, this is the website of NSE. Here onwards, you can see the how many indexes are there. I will again show you how to go there. So here onwards, you can see view all indices. That means view all sector. And here Nifty 50, 500, mid cap, small cap. This is important. But here are the sectors: bank, auto, financial services, 2550, FMCG, IT, media, metals, pharma, PSU banks, private bank, reality, healthcare, consumer durables, oil and gas. And even here you can find that what are the dividend opportunity, which companies gives the maximum dividend yield, which is the having the highest weightage according to Nifty 200, 500, thematical indices like commodities, consumption, energy. So you will be finding n number of things on NSE website, and this is one of the best website where you can see n number of data. This is having immense information for any of the person who are looking for investment trading purpose. Because once I click, let's say for example Nifty IT, it will tell you how many stocks are there in the Nifty IT index. I don't know why it's taking time, but here onwards you will be getting the data that once it uploads, I will again show the screen to you. So this is where you can see that how many sectors are there and what are the stocks are there in the website. Meanwhile, I will show you the screener website where you can check that how you can find any relatable company. Is this visible?
Yes, sir.
See, so this is the home page of screener.in. Whatever company you want to do the analysis, you can simply write it over here, like say Reliance. So you will get all the data here, that what is the stock PE, return on capital investment, what is the book value, current market price, face value, how much is the face value about the companies. Then here is the chart, how it is performing 3 years, 5 years, 10 years maximum. So you can get all the information from this website. Then there will be analysis, that what are the pros connected to the company, what are the cons connected to the company. These all are free websites. So that's why I'm showing you, so that you people can get good information from strong websites which are having relevant data. The data are very much relevant, even for our purpose also. Many a time we refer these websites also, because this is a pretty handy information that we get very easily. Then which are the peer companies? So IOC, BPCL, HPCL, MRP. So here I can see the what is the PE ratio for Reliance. The PE is 25. For BPCL it is 22. For rest of the companies the PE is very less. So either I have to check why the PE is very less. So you can see the dividend yield for this one is very low, Reliance, but the government backed companies are having good decent dividend yield ratio. So here also then again you can see quarterly how much net profit this company is making quarterly, how much variance is there in the company, and how much return on capital employed is there, that you can see. And whenever the return on capital is something which is near to as I mentioned approximately 10 to 15%, that is considered to be a very good company. So all the companies are giving a very strong ROCE. So this is considered to be a very strong companies, all the peer companies also. Then this is the quarterly result, that every quarter how much has been the sales, expenses, operating margin. From here you can tax the EBITDA also, that what is the EPS. So EPS has been always on the higher scale. You can see 16, 17, then 20. This one highlighted March it went down to 9, but again 20, 15, 20, 20. So that means earning per share is also very positive for the company. The profit before tax and even net profit is also on a higher scale. So that means the company is performing really very well. So this will be a very strong fundamental company. Profit and loss, balance sheet, cash flows, everything you can see over here. Even the ratios, because in fundamental analysis we see a lot of ratios ki ROCE percentage kitna hai, what is the capital working capital days that is required in this company. So everything you can see here, even the portion of FIIs, how much FIIs have invested in this company in which month. So whether they are increasing their share, where they are decreasing their share, how DIIs are taking up the view, whether the DIIs are increasing the share or decreasing, even the government bonds, government companies like LIC. So many of the companies, even the public, how the public has been appreciating or depreciating the main their own position in the company. Everything you will get over here. Annual reports, credit rating for the company, everything, all the information that will be required to know in and out of the company, every single data will be presented over here. Now I guess this has been uploaded, which I have clicked Nifty IT index. If you guys remember Nifty IT, which I wanted to show you, that from sectors I clicked on Nifty IT, and here are again I closed it, so sorry. And from here onwards, I can see that what are the companies listed in Nifty IT index. So Infosys, Mphasis, LTTS, Wipro, LTI, Techem, Coforge, HCL Tech. These are the companies that are under Nifty IT index. So whatever is the index, consumer durables, pharma, healthcare, banking, private banking, uh, uh, capital goods, whatever is the index, you can find out how many stocks are there in the index and what is the overall performance. Everything you can see from here. And if you want to do a proper peer analysis, then you can do the peer analysis over here or here also. Like say Infosys, I wanted to do a peer analysis of Infosys. Then we can see Infosys, TCS, HCL Tech. See the PE ratio for TCS and Infosys is around same, but HCL Tech, Wipro is near about 10% or declining. So from here onwards, we can expect that these companies will be having a potential, but again, that we have to see how much return on capital has been gained. So for TCS, it has been 54%, which is very strong. These companies are having 20. So overall, the ITs has been giving a return on capital employed is very much strong. It is just because the provision, the view for the companies because of the global recession is not very strong. So we are witnessing some kind of downward move in IT firms, because we can see the technical chart of Infosys. So from 19,000 in the month of March, from there onwards it has went down to 1,400. But again, if we will see the overall structure, then it has always been in the uptrend. So if these levels came here, see again, I will show you again from here, 17 June, it tried to again move upwards, but again because of the US fall in the US market, it again went down, and again from here onwards it started moving upwards. So that this levels on technical chart, if you will ask me, then these levels approximately near to 1400 or 1350, these levels could be considered to be a very strong support. Immediate basis pay 1600 will be the target or resistance. Once it crosses 1600, then the continuation of uptrend will continue in these counter. So that's why you always have to see the fundamental of the company and technical to get into the company, that when you should buy and when you should exit the company also. Because at 1600, once the price reaches to 1600, then there will be some kind of tentativeness that whether it will breach 1600 or whether it will again go down towards 1400. If it breaches that levels, then again you should put more money or you should buy more stock, because from here onwards we can expect the lifetime highs to be tested again. So these are few of the things that we people have to keep on analyzing, that we people have to keep analyzing on day-to-day basis. So this was it. I guess your questions has been covered. Now I'll be fastly covering the difference between technical and fundamental, and then we'll move towards the derivative. So I assume till now you guys are getting all the points which I am trying to say. If you guys have any question, any problem, any thing which is not being understandable easily, then you can again ask it to me. I can again tell those things to you people. For US market is TradingView. In TradingView, you can look for whatever stocks in global scenario. TradingView mein you can see the fundamentals also, technicals also, for all the stocks that are related, that are in the secondary market. TradingView is the website you can see there. Now I'm moving towards the main technical and derivative analysis. I will try to cover major of the parts because I won't go into the total technicality, because many things will be something which will be you people will be listening for the first time. So I won't be very much technical, but I will just give you an instance that what are the things that you people have to understand before investing in capital market. So in if I'll talk about the research portion, so research, which I have already covered, that technical and fundamental part. But if you are going to decide that which analysis is better, then the answer is very, very difficult. Why? Because combination of both the researches is something where you can make money. If you are only dependent on fundamental analysis, then it will be difficult for you to get the entry and exit right. If you are totally into technical analysis for short duration, yes, you can. But for longer duration, you have to refer fundamental analysis, because if the company is not soundly occupied or not fundamentally sound, then you can see some kind of fall in a very drastic manner. So the major difference that we have seen in fundamental and technical is fundamental basically teaches about what company is performing, what are the things that affect the performance of the company, while technical is something which is a statistical tool, which uses price volume data to identify where one should get a perfect entry and where one should get a perfect exit. The second is in the methodology. In fundamental, financial statement, financial data is the main function where we all focus in fundamental analysis. But in technical, those factors are not accounted very much, because we assume that price action or market price discounts all the other factors related to the stock, related to the company, listed companies. The time horizon for fundamental is mostly longer duration, more than a year time frame. But for technical, it can be even short term, it can be even intraday. That means today only, today buy, today sell only. Then medium term and even long term perspective also. The fundamental research is majorly used by those who don't track the market on a day-to-day basis, who just try to invest in good companies and want to see a good return over a period of time. But technical is something where trading is where trading activity happens. That means you have to buy, you have to sell, you have to keep track your portfolio, you have to see the market on day-to-day basis. So these are the major differences between fundamental and technical, but both goes hand to hand. It's not that this one is better or that one is better. Both of them are have their own significance, and if both combine together, then they will be having a deadly combination. You cannot beat the equity market from thereafter. I'm not going about the history of technical analysis because that is not required for you as of now. So in general, I will explain that why things, what are the things that we expect a technical analyst or a research person to see in technical analysis. First point, which I have already covered in number of times, that price discounts everything. That if the price is going higher highs or making higher highs, then irrespective what is the fundamental aspect, what is the time horizon, I am least bothered about all these things. I see the market as being a very outperformance in the market. Second, price movements are not totally random. Why? Because if we will see, there will be a kind of a pattern made in all kind of trades, that we can see a kind of symmetrical triangle pattern breakout, rectangle consolidation breakout, or a kind of double bottom head and shoulder. There are n number of patterns that is seen in technical analysis. So from here onwards, we can see that what are the things that we people have to analyze in market. That market always moves in a trend. Either it will be uptrend where we can see higher highs, higher lows. Either it will be in the low trend where we can see lower lows, lower highs, or it will be in the sideways or consolidation phase. That means it will get stuck in a very narrow congestion phase where there will be very low fluctuation in the market. So these are the three typical trends that people can see in any kind of market, because apart from these three, there won't be any fourth one for the trend analysis. Now we have to see what is the trend for trend analysis. What is the time duration has been quoted, that in what time this much of analysis has happened. This is the pattern which has been made. This has taken what kind of duration. Then what is the volume? The volume and its significance is also very strong, because let's say, for example, in any of a company, let's say every day daily transaction happens at 100 volume, but on one day you see the number of volume has increased from 100 to, let's say, 500. Then there we can see that new participants have joined in the trading volume. So from here onwards, we can see a strong move, or if the prices are on the downfall, then we can see a strong sell off in the counters also. This is a very important part, that where we find the support and resistance. So as I mentioned, even in the example of Infi, which I just have shown you, that 1400 levels, 1350 levels, where we have seen a strong recovery from Infosys, and higher end pay 1600 was the resistance. So as you can see on your screen, these levels have been tested as a strong support. Whenever these levels are getting tested, the market is again moving towards higher end. So these will be considered as to be a strong support. Same way, the resistance where the market is finding it difficult to move beyond that point on the higher level, that will be called as resistance, where the supply zone is greater than the demand zone, that people start selling their shares once that price is came. So that's why price again falls down, and on the support where the demand zone increases, where people expect that these prices are very good, fair valuation, we should buy the stock at these levels. So that's the support zone, and where people feel that this is the overvalued, from here onwards we should sell the counter, then that is called the resistance zone. The various charts which you have to see is line chart, bar chart, and candle chart, which I have shown you on my software was the candle chart. So candle, every chart has its own significance, but majorly if I will say, then candle chart is something that is being used in day-to-day life, because it gives a lot of information, that what was the open, what was the high, low, and closing. And on that basis, I can signify that whether it has been a bullish, like I mentioned that on Friday, it was a bullish engulfing pattern. So there has been n number of patterns also. So this is one of the chart which is used majorly, but no doubt, just a line chart eliminates all the other noises. It tells you only the closing price, that it started at 100 and closed at 102. In between, whatever happened, it does not matter to me. So for investor, line chart is very much important. For trader, candlestick, even for investor, candlestick can be seen. So these are few of the chart patterns which you will read later, because as of now, that is something, a lot of technicality will be there. It will be difficult for understanding, and it will be of no use as of now, because once you're not into the equity market, then understanding these candlesticks pattern is something that is not very much important for you guys as of now. But you should understand that how these things work, because accordingly there will be kind of entry and exit, which I told you that entry and exit is very much reliable on the technical charts. Then how the candles are formed, how we can expect that from here onwards, what we can expect from the candles, and accordingly we can trade. But what is important for you guys is to understand the trend pattern. This one is very much important, because here onwards you can expect the trend, because this is for a not for a very short period, it is for a long duration. That if these things has happened, we can see like in the continuation patterns, pennant, flag, rectangle, these are some of the things that shows that there will be continuation in the trend. If the trend is upward and these patterns have been seen, then we can expect the pattern to get continued on the higher end. But the reversal pattern are something where we can expect that if this pattern has been made, then we can expect the reversal. If it is in uptrend, then it can start going downwards. If it is in downtrend, then it can start moving upwards. So these are few of the things that we people have to see on day-to-day life, that for people like us who in general trade, who in generally see that what are the formations that is happening. And for short-term duration, let's say for 15-20 days, if this pattern has been made, then the how much target can I expect in how much time frame. So that is there that we people have to keep on analyzing on a day-to-day basis. But as of now, this won't be having very much significance for you guys. Like just for example, this is one of the trend pattern called a bearish head and shoulder. Why? Because of the shape. Because if you are good at geometry, you can see that what is the pattern is being making and how much returns can be expected from this one. So you must have listened from someone that whenever a recommendation is given, it always comes with a stop loss and a target. So how the target is being calculated is through the patterns which it has been made. So if the pattern has been made over a period of, let's say, 10 days, to the target, whatever is the target, that target will be expected to be reached in the next 10 days. That is theoretical basis, but in practical basis, within 6 to 7 days, the target will get achieved. Because once there will be a breakout, then volume increases. And once the volume increases, that means number of transactions, number of trading volume, that also increases, because of which the momentum in those fall or in those rise increases. So that's why time frame, which is of 10 days, that reduces in practical to 5 to 6 days only, but theoretically it is 10 days only. So there will be a number of things, like I told you for Nifty, there has been a gap from where Nifty made a reversal and made a bullish engulfing pattern. So that's a very positive sign for Nifty, because the gap is something where there has been no trade zone. If there 100, the next day we have seen 95 or 105, that means in between 100 to 105, there has been no participation. That means there has been no trade. So if the gap is retested, many people who have bought at 100, they won't participate, because they think still the prices are on the higher end. So why to again sell? Why to get panicked? So if it breaches that gap, then it will be a term of a panic. But again, if it breaches if it fill the gap and breaches 100, then it's the time for panic. Sometimes it might test the gap, but again it starts moving upwards. So these are few of the gap theories that we people see on our day-to-day life, that what are the breakout gap, what are the runaway gap, how there will be a common gap, and what is a island gap also. So there will be a number of things and that we see on day-to-day basis. These are few of the indicators that we should actually implement in our trading routine, because just simply seeing the technical chart won't suffice the proper movement. So we have to relate it with the commonly used indicator. So some of them are RSI. This tells you the overbought and oversold region, that at what level the market has been oversold. यहाँ पे a lot of people, the sentiments have turned way too bearish. So from here onwards, we can expect a strong reversal on the higher end. And once it reaches on the higher end towards overbought, that the market has been very much overbought, very much strongly bullish. So from here onwards, better to cool off your profit, better to take some money from the table and relax, so that the prices, once it falls down, again you can buy the same share. Then there is a next term called MACD, moving average and convergence. This shows the positive crossover. Then when the crossover has been happened on a positive side with the price movement, and or whether it has happened on a negative crossover on a price declining. So these are few of the technicalities that how it is calculated. But as of now we people have the software, so we manually don't have to do anything. We just can simply put these indicators on the software, and these things will do work for us. But if you want to understand the overall technicality, that how does it work, then it is very much important for you to understand the formulas, because being a student, remembering a formula is very much difficult, and even one feels like what is the use of this formula. Practically that's correct, but if I will tell you that understanding a formula is very much important, because that will give you a clarity on the concept, that why these things are happening, why we people are uh, mugging up the formula. So that's why even when I was a student, it was difficult for me also to go through all the formulas. 30 formulas were there in financial market only. So it was difficult, but now when I see to those things, yes, I don't use them right now, but I can relate to the concept, that why my concepts are clearer, because I have known how and why to calculate these things. So that's why remembering formula or going through the formula gives you a positive returns in future. Now the some indicator is stochastic. This is also overbought, oversold region, and it shows the presence of divergence, which is of when the prices are moving higher and the indicator is moving lower. That's a divergence, and both when both are moving in tandem, that's convergence. So that's a very, again it will give you that what will be the oversold and overbought region. Bollinger Band is most commonly used. Even I use Bollinger Band, because it tells you that what is the we have to calculate the standard deviation in it. Obviously the software does it, but this tells you that at what point the market is going to take support and at what time market is going to get uh, resistance, and meanwhile when we can expect an outburst or huge movement in the market, either on the lower side or on the higher side. And moving average is one of the simplest thing that I have shown you, that 200-day exponential moving average, which I have shown. From there onwards, Nifty has turned around. So those are having their own implications and their own significance. Like 21-day crossover of short moving average over higher moving average is considered to be a very positive movement in equity market. So there will be a number of things that you people will get to know once you relate directly to the equity market. So meanwhile, this was it from the technical perspective. If you guys have any questions as of now, you can ask me, else I will directly move towards the last section of derivative market. Any questions, anyone? I know this was a bit technical kind of a thing, but this is how the technical analysis works. So in general, if there will be anything that can be relatable to you, or in future also, you can even ask me in future dates also. So I assume there is no question. So I am directly moving towards the last topic for the day. Then you can enjoy your weekend. So the last topic is the derivative market, where the question which one of you have asked about forex trading will also get clear. Whether my screen is visible, can someone answer, please? Okay.
Yes, sir.
Okay. So derivative market is one of the most traction appealing market in today's world, because a lot of people have started investing in started trading through derivative market, because it gives you a very strong return in a very short span of time. And here you don't have to even deploy 100% capital also. You just play on the margin, you get decent return, you exit from the market. You don't have to stay invested in the market. But that was not the concept why it was introduced. Derivative market was introduced to hedge the position. So for example, let's say I am having an equity portfolio of, let's say, 10 lakh rupees. So when the market is volatile, when I am expecting a lot of volatility in the market, there has been, like for this calendar year, when the global markets have corrected mostly more than 20%, our market also corrected approximately 12-13%. So my equity portfolio of 10 lakh will also get affected, and it can come down towards 90% or 10% of erosion can happen. So to overcome those kind of erosion, the introduction of derivative market was happened. Why? Because whenever we expect volatility to persist in the market, we can use derivative market as a tool to hedge the position. Now, when I say to hedge the position, as in to minimize the losses, whatever portion I am expecting that this much of portion is exposed to risk, I can reduce the risk through derivative tool, through n number of strategy. This is a bit complex, but gives a lot of return. And once you are dealing in money in day-to-day life, if you are making, let's say, if you are making a, let's say, 1-2 lakh rupee per day, and then even the complexity is started to look like very easy for you guys. So derivative market in today's world, because there has been fascination of cryptocurrency, foreign market, foreign exchanges. But for me, if I would say that derivative market, even in Indian equity stocks, will give you more returns as compared to whatever currency you can expect in the market. But forex currency is totally different. I am telling this with the reference of cryptocurrency. So derivative market was introduced way back in terms of contract. Forward contract was the initial thing that were having some loopholes. To cover those loopholes, future contract came into picture that has been taken care by the exchanges. The exchange take care of the future contract. That means all the things has been authorized and provided standardization, so that there should not be any loophole present in derivative market. Then there is a term is options market, and there is a term called swaps. Swaps is in general used for forex trading, where the whatever is the change in currency rate depending on nation to nation, we people have to invest, or the currency people have to invest accordingly, so that the position should be get hedged. In Indian terms, if I have to explain the example, then it will be fixed rate of return and floating rate of return. There we are having a fixed rate of, let's say, 8%, just for example, and floating rate is, let's say, of 7%. But fixed rate always say that whatever happens, even the rate is going to hike or rate is going to get cut, my interest will be 8%. Floating is with, it moves with the market, that whenever it moves higher, whenever the market moves higher, it moves higher. Whenever the market moves lower, market as in terms of RBI, whenever they quote a rate hike, it will increase. Whenever they quote a rate fall, they will decrease. So there will be uncertainty to floating market. To safeguard that floating interest, floating rate of return, I have to hedge the position through forex trading. Because once you are dealing in lakh and crore, there is no need for forex exchange hedging. But when you are dealing with 100 and 200 or 1000 of crores, then you have to hedge the position, because even a slight change of 10 basis point also is going to have a very strong impact on your day-to-day forex exchange trading. So that's why whenever the fund size increases, it will increase the hedging perspective. So hedging in overall is the term called where we put a strategy, so that whatever happens in the market, we should not get more than this much of loss. That means I am mitigating the exposure to risk. That if these things happens, I will be having this much limited risk only. For example, I will be having, if there will be 10 basis point of change, I will be having a risk of only, let's say, 1 basis point. But if it won't change, then I will be having an exposure of, let's say, 5 basis point of positive movement also. And when you are dealing in thousands of crores, you don't expect to get 10% or 15% return. First thing that you have to do is to safeguard that capital, because if that capital get erodes, it will cost you a bomb to get that capital back. Correct? So first thing, you have to safeguard it. So you have to put a strategy so that at least the capital is secure whatever happens to the market. And if I am getting 0.5 or 1% of return also, so that will be sufficient enough for me to gain that much of profit, because from 1000 crores, if I am getting 1 or 2% of return, that will suffice strong returns on day-to-day basis. So that's why derivative market was introduced, to hedge the position, to safeguard the position and minimize the risk exposure. So broadly, it has been divided now into futures and options. Future is something where two different parties, buyer and seller. Everybody knows there will be one buyer, one seller. But again, what are the trades between beside them is something which is very much important. That means buyer has to pay the money. If let's say I have to buy something 10 rupee of cost, so I have to pay 10 rupee, correct? But at whatever happens after it, what will be the exposure to risk? That will be 10 rupee only. If I have given 10 rupees, so maximum loss can be 10 rupee, not more than that. But if I have bought something at 10 rupee and it went to 100, how much profit I am going to earn is 90 rupees. So these are the trait of a buyer. Buyer pays the premium, losses are limited and profits are unlimited. But if I am a seller, I will be selling a thing for 10 rupee. So against, I will receive a premium of 10 rupees. So being a seller, I will receive the premium. And if I have received 10 rupee, what will be my maximum profit? So my maximum profit will be limited to 10. So that is the only thing that I am going to earn. But if the prices from 10 move towards 100, then how much money am I losing? So that is 90 rupees. So being a seller, you receive the money first. Second, your profits are limited and losses are unlimited. Buyer, you have to pay the money, but your profits are unlimited and losses are limited. So these are some of the trade that we people should understand whenever we deal with the future and options market. Now in future, we have commodity futures, index futures, stock futures, and currency. So everything in future market is being taken care using futures and options, so that I can make a strategy and can hedge my portfolio. So options has been broadly categorized into two phases. One is call and put. This is the security analysis. This will be in the security analysis paper. So you can refer this as the initial stage of understanding. So option has the two categorization, call and put. Whenever I have this sentiment that from here onwards, prices should move upwards, higher, from 100, it should go to, let's say, 120. So that is being presented by call option. And whenever I have the feeling that prices from 100 should get towards 90 or 80, that means I am having a bearish view in the market. In equity, in options, in equity, overall equity market, there will be a two term called. One is a bull, one is a bear. Bull is when we expect market to move upwards, and bear is the symbol for fall in the market. So I might use these terms, so that's why I have given a clarification before. So whenever my view is bearish in the market, so that's why put option is going to represent the bearish view, that whenever I am expecting prices to go downwards, and when I expect prices to go upwards, it has been presented by call option. Now, some of the important terminologies that we people have to understand is, first one is the underlying asset. So derivative market itself says that it has been derived from something. It does not have a dependent value. So its value is dependent on the underlying asset. And when we are talking about equity market, so those underlying assets are the equity prices. That means whatever stock prices is trading at cash market. For example, Tata Motor is trading at 400. So that 400 will be my underlying asset. Apart from it, I will be calculating that what is the premium for future and options. In options, we have a strike price. That means if Tata Motor is at 400, so in options, we will be having 410, 20, 30, 40, and so on. And downwards, may 400, 390, 380, 370, 360, and so on. So that as per my own free will, leverage, and anticipation, I can opt any of the strike to buy or sell my options, either call or put. So these are some of the things that will be having complexity, I can understand. But again, these are very much important once you try to understand equity market, because from here onwards, this will be the first phase where you can start looking for opportunities where you can make good handsome amount of money on day-to-day basis if in market. If not, hedge the portfolio is also one of the point that you can do in derivative market. The second is the spot price. Spot price, which I have mentioned, the cash price. Tata Motor 400 will be the spot price. Premium is the option. On 400 call option is trading at what premium is being taken care by time value, that is theta. That again has a calculation through Black-Scholes model. And I assume you people would be having a Black-Scholes model in your financial third sim or fourth sim, I guess. So Black-Scholes model will be also there to calculate the premium. So that is the important factor on the basis of which the option strike increases or decreases. The last one will be the expiry date, because as we are talking about derivative market, this comes with a contract. Here you are not dealing with any physical settlement of share. Here you are dealing with the contract. So once the month is getting close, let's say for October month contract will get expire on the last Thursday of October. So on that day, my theta, my time value will become 0. So Greeks, I am excluding as of now, because Greeks is something which is having a lot of statistics associated to it. So that better to stick with the professor, because he will be explaining you on the Excels or on the board. But I could not explain you the Greeks, because that is a lot of calculation, variance, standard deviation, means, everything has to be calculated to go on the Greeks and even further basis also. So I am excluding the Greeks as of now, but for understanding, as of now, what we are using from Greeks is theta. So theta is nothing but the time value. Like from here till from today to the expiry of October, that means October month end, we are having approximately, let's say, 15 days of time frame. So for, let's say, my time value from now onwards till the expiry is 15 days. But as we directly move towards the expiry, for on 20th of October, it will be 7. On 25th of October, it will be 2. On 27th of October, it will be 0. So theta always moves in a diminishing way from higher levels to lower levels, and on the expiry day, it becomes 0. So that means on expiry day, your premium becomes 0. So there are parties which are involved in options market are first one who buys call option, second who buys put option. So there is a difference between both the buyers. Call option I buy when I expect the market to move upwards. Put option I buy when I expect market to go downwards. Now from the writers, seller's perspective, I will sell a call option when I am expecting market not to move upwards, and I am selling a put option when I am expecting market not to move downwards. It should move upwards. So there is a kind of a thing that we people should understand in the market, because call buyers are someone who expect market to move extremely bullish in the market. Sellers are those who are moderate, call sellers are those who are moderately bearish in the market. If you want, I can share this PPT with you guys, so that even you can relate it with the time when you read the theoretical part of this one, so that it will be easy for you to understand everything in detail, because this is the nutshell of the chapter that you are going to analyze in security analysis. So you can have this as a reference. Once you read that theoretical part, it will be looking like a piece of a cake for you guys. So to understand that what does call seller, call buyer, and put seller and put buyer represents, and what are ITM, ATM, in the money, at the money, and out of the money. So I'm directly moving towards the strategy, so that you people can understand that what the term called hedging is all about. So let's say there are, as I told you, market are in three trend. One is bullish trend, uptrend, that is presented by bullish. One is downtrend, presented by bearish, and the one is sideways, that is presented by neutral. So the language is different for technical and the language for derivative is different. Overall story remains the same. Bullish जब market higher highs जाता है, bearish when market falls lower lows, neutral when it is in a consolidation phase. So when the market is bullish, there are some of the strategy which you can take to safeguard the position and even to make money from the market. When the market is bearish, these are some of the strategies, and neutral, then these are some of the strategies. Now, starting from the bull, when you are expecting a strong movement, first one is bull call spread. In bull call spread, one OTM option is bought. That 400 was the price of Tata Motor. So OTM will be 400. 400 call option I am buying. Sorry, ATM will be a 400. So I will be buying 400 call option, and OTM will be, let's say, 440. OTM is out of the money. So 440 option I will be selling. So I am buying Tata Motors because I am expecting to have a bullish run, positive move. And I am selling OTM, the price which is not there in the market, but I am expecting 440 to be the resistance for Tata Motors. So I am selling that option for 440 call option. Why? Because if there will be a move positive as per my anticipation, so buying ATM will give me money, but sell OTM will not give me money, but it will depreciate in a lesser form. Why? Because it is out of the money. So theta factor for OTM will be much less as compared to the ATM money. So theta for the momentum, it will rise, and the momentum it will fall will be different. The rising momentum will be much larger and the falling momentum will be much lower. That means you are getting 10 points and you are losing 2 points. So overall, you are making 8 points in the strategy. So these are some of the strategy which you can do in bull call spread, which you can do to hedge position. Even when your anticipation goes wrong, then the position where you have bought, that will create loss, but the position which you have sold, that will start giving you money. So that means even whatever happens to the market, even if the market falls from 400 Tata Motors, let's say from 400 it went to 200, but you are not going to lose a strong huge amount. A minimal amount of, let's say, 5,000-7,000 rupees will be lost, and you will be exited from the position. And even if that happens, then you can again review the strategy so that in the downtrend you can make a bull put spread and bear put spread, and you can make the positive movement from the positive returns from the downfalls. So there has been n number of strategies that could be seen. When the market is neutral, then we can see a lot of strategy also. So this chart I will send you over the mail so that you people can, once you understand the overall derivative market, then you can look for these strategies by your own, and then it will be very easy for understanding also, because as of now, if I will be explaining OTM, ATM, ITM, it will be very difficult for you to understand for the time being. So I will be explaining it. Even if you feel like to connect with me in future dates also, you can connect to me and you can ask whatever doubts you will be having. I will be happy to assist on all the doubts. So that's it from my side. Now, if there are any questions you want to ask, you can ask me now. Else I will wind up the session for the day then. Any questions, anyone?
I think yes. Yeah, I think it's a long session, isn't it, Mr. Osho? It's a very long session. 3 hours.
But actually, it is an interesting topic for me, so yeah. I might carried away with the momentum, but then it's all right from my side. But yes, on your weekend, I have taken a lot of time.
No, it's not really. Actually, we have taken your weekend. You are so much engaged for the whole week. And taking it this one weekend, and you are giving all the support for our students, ASBM students. It's really a great honor. Thank you so much, Mr. Osho.
Thank you so much.
Thanks a lot for your support. It was a long day. Actually, I was waiting to have this session, and happened like your marriage and all those happened after that. then we want
Yes,
to give
yes.
some time to you to adjust everything. Then I think we want to have.
No, no, thank you so much for inviting me, sir. I hope we will get connected again.
Yeah,
And
sure,
for
sure, sure.
students also, if they want to connect for any of the doubts related to equity derivative, fundamental, whatever it will be, capital investment market, you can connect to me. I'll be happy to assist on anything. Thank you,
Thank you
everyone.
so much. Thank you so much, Mr. Osho. Have a great day and a great weekend. We'll meet up again.
Yeah, sure.
Hope to see you soon in Coimbatore. Yeah, we'll try to
Yeah,
make
sure.
some arrangements.
I'll
Yeah,
definitely let you know.
yeah. Okay. Thank you so much. Thanks a lot. Thanks, students. We'll see you again.
Thank you, sir. Thank you.